We had our first June industrial number in the form of Empire. Should we really concern ourselves whether it's good or bad with these regional data points? I mean, I don't know. When I think of manufacturing, I don't necessarily think of the Gotham City. But yet embedded in this number were some pretty decent data points, were there not?
Yeah, the headline number held at the highest level in a couple of years, which is obviously a good thing. We're certainly seeing that spring rebound, and we're seeing a better economy in Q2 relative to Q1. But the New York number doesn't necessarily correlate well with other regional surveys. And the $64,000 question for the markets is not what happens in Q2 GDP, it's what happens in the second half of 2014.
Yes, that's where we're definitely going to watch interest rates and see how they respond, because I think what you're hinting at is no matter what happens in the second quarter, the averaging in the first isn't going to look good. Let's move to a second front. Let's talk tick data. On the surface, it looked like China was a seller of about $8.9 billion, but that isn't really the story, is it, Peter?
Yeah, they let an enormous amount of bills mature, and they only reinvested some of that in notes and bonds. So their total holdings of U.S. securities declined, and that has been actually in a steady decline over the past bunch of months, and Japan is actually getting closer to being number two. So that's obviously noteworthy from a bigger picture standpoint in terms of the U.S. dollar and longer-term interest rates.
All right, now the big news last week was Mr. Carney supposedly threw the world in a tizzy with the notion that normalizing interest rates is going to happen sooner rather than later, and the markets seem to be dealing with it okay. Is this really going to be a cakewalk? Are we forgetting about balance sheets and the fact that most assets have priced off of cheap capital now for close to a half a dozen years?
Right. It's very easy for a central banker to say we're going to normalize things. It sounds so nice. But when you have asset prices and an economy that's based on abnormal interest rates, that is not an easy transition to make. And all you have to do is look at the 2-year gilt yield, which is at a 3-year high today. So anybody who's long that is obviously not having a good couple of days. So I think that the market's way too nonchalant with this exit strategy on the part of the Bank of England, but also the Fed. And this is going to be a lot more disruptive and messy than investors think.
Now, when I look at the spreads between U.S. and boons, I get one picture, but an even more aggressive picture is between boons and gilts, so the U.K. and Europe. Your final comment, that's the 17-year widest that relationship bid. What conclusions can I draw from that?
Right. We know the ECB is on a completely different path than the Bank of England. The ECB is obviously one step just below printing money to try to generate growth in their economy, while the Bank of England is more in line with us, and that they know the time is up for this easy money policy, and it's time to normalize, even though normal is not going to be necessarily what the old normal was with respect to interest rates. We know they're going to be lower for a lot longer than anybody would think.